Let us talk about the exact math of your very first $100 in the market. It sounds like a negligible amount of money, right? But the specific decision you make with this single bill will dictate the trajectory of your entire financial life. We are looking at a massive, undeniable mathematical divide today. If you take $100 and park it purely for long-term compounding growth, historically mirroring the broader market over a 30-year timeline, that single bill transforms into something north of $1,700 without you lifting a finger. But what if you take that exact same $100 and chase immediate cash payouts instead? What if you go after those high dividend yields that look so attractive on paper? You are left staring at a slow, agonizing trickle of pennies, perhaps generating a mere $4 a year in cash flow. That is the staggering mathematical reality we have to confront right out of the gate. So, why do so many smart people get this entirely backward? This is what we call the ultimate beginner trap. When you first step into the financial markets, reach them open the financial markets, human psychology immediately plays tricks on you. You look at high dividend stocks, legacy companies paying out regular cash, and you think to yourself, this is guaranteed. This is safe. This is literally free money hitting my brokerage account every single quarter. It feels like a tangible reward. Meanwhile, you look at the S&P 500, a massive index of the 500 largest American corporations, and you view it as a highly volatile casino. You see the red days on the chart, the market swings, and you naturally want to protect yourself, so you choose the safe dividend payout. But here is the massive paradox of modern investing. By choosing what feels psychologically safe today, by grabbing those tiny quarterly cash payouts, you are actually systematically destroying your own long-term wealth accumulation. You are permanently capping your own exponential growth right at the starting line. The very financial mechanism you thought was protecting your portfolio is exactly the thing keeping you poor. Which brings us to a highly critical crossroads. If you're starting from absolute zero, if you literally only have a single $100 bill to invest right now, which path must you actually take? Which asset class will truly build an unbreakable financial foundation for your future, and which one will simply keep you running in place on a treadmill, perpetually chasing pennies while the real generational wealth is being generated somewhere else? To understand this, we have to look back at how the game was originally rigged. Decades ago, if you walked into a brokerage with a single $100 bill, they would have laughed you out of the lobby. You needed thousands just to open an account, paying exorbitant commissions on every trade. Back then, dividend stocks had a highly exclusive purpose. They were the ultimate yield vehicles for wealthy retirees. You built a massive portfolio over a lifetime, then lived off the quarterly cash distributions. Meanwhile, the S&P 500 was a monolithic vehicle designed to park institutional wealth. It was not built for a beginner. But then the financial landscape fractured. The catalyst was a technological shockwave that obliterated those legacy barriers. We saw the sudden explosion of zero-commission trading apps and the invention of fractional shares. You no longer needed $3,000 to buy one share of a tech titan. You could slice it up and buy exactly $100 worth of anything. This shift democratized the market, but it created a terrifying new reality. It forced complete beginners, armed with nothing but a smartphone, to make complex asset allocation choices once reserved for Wall Street managers. You are sitting there, forced to decide where to deploy your capital. So how do you make that choice? You must look at the absolute first principles of corporate capital allocation. Why do these two asset classes behave so differently? It comes down to what a company does with its profits. Look at the monopolies driving the S&P 500 today. When they generate billions in free cash flow, they do not hand it back to you. They hoard it, relentlessly reinvesting into artificial intelligence and global expansion. They compound that cash internally to drive the stock price exponentially higher. Now look at a high dividend company, like a legacy telecom provider or a regional utility. Why are they paying you cash every quarter? Because they have fundamentally run out of high growth ideas. They literally have nothing better to do with their profits. They cannot build a revolutionary data center, so they hand the cash back to you simply to keep you from selling their stagnant stock. So we have this absolute bilateral conflict right in front of us. You are standing there with your $100 choosing between two opposing forces. Play array is the offensive strategy of the S&P 500. This is pure total return and aggressive capital appreciation. Player B is the defensive strategy of high dividend stocks, focused entirely on immediate cash flow right now. We must run your $100 through a ruthless 3-point evaluation framework to see what actually happens to your money. Number 1 is the time horizon rule. Buying the broad market means committing to decades of exponential growth, while buying a dividend stock means prioritizing tiny, immediate payouts every 90 days. Number 2 is the tax drag reality, the silent killer nobody warns beginners about. Every time a utility company pays you a dividend, the government steps in and taxes that cash as ordinary income. You bleed capital every single quarter, but the S&P 500 defers those taxes. That internal corporate growth is entirely tax-free until you finally hit the sell button, and decades down the road, letting you keep absolutely all the compounding momentum. Number 3 is the reinvestment mechanic. To even attempt to match the broader market, you are forced into a dividend reinvestment plan. You must take those heavily taxed pennies and continuously buy back fractional shares of the exact same slow-moving company. Let us look at the hard, undeniable evidence and run the exact math on your single $100 bill over a 10-year period. Historically, the S&P 500 delivers an annualized return of roughly 10%. Compare that to a standard high-dividend ETF, giving you a 4% yield plus a sluggish 2% of actual stock growth. Fast forward exactly 10 years. Your $100 in the S&P 500, compounding silently at 10%, transforms into roughly $259. You have more than doubled your money without lifting a finger. Now look at the defensive dividend strategy. That same $100, grinding away at a combined 6% return, grows to just $179. You left massive wealth on the table. And what did you actually get for sacrificing all that capital appreciation? You received a measly $4 yearly dividend payout. $4. Are you going to build financial freedom with $4 a year? Absolutely not. A microscopic dividend payout does not change your life, but compounding exponential growth absolutely does. Absolutely not. A microscopic dividend payout does not change your life, but compounding exponential growth absolutely does. We pull these granular data points together into one undeniable macro trend. For a super beginner standing at the starting line, the absolute total return of the S&P 500 is the only mathematical engine that matters. You cannot build a financial fortress by stacking pennies. That $4 payout is a mirage. It feels like income, but it is an anchor dragging down your wealth accumulation. You are trading life-changing growth for the illusion of immediate safety. But here is the unresolved variable in our equation. The wild card Wall Street algorithms cannot quantify. Human psychology. The S&P 500 is a relentless wealth-building machine, but it is also a violently volatile beast. It can drop 20% in a single year. Are you prepared to watch your $100 suddenly shrink to $80 on your screen? That is where your panic threshold is tested, and exactly why beginners get lured into the dividend trap. Receiving a physical cash dividend triggers a massive dopamine hit. It feels like a tangible reward. That psychological comfort blanket prevents a terrified beginner from panic selling during a crash, even if the underlying math is suboptimal. So where does this leave your first $100 bill? Let us project your trajectory. The roadmap is brutally simple. You must dedicate this first $100 and the next 10,000 entirely to the broad market index. You are in the wealth building phase, not the wealth preservation phase. You do not need income today. You need maximum velocity. The transition into our new paradigm, the pivot toward high dividend stocks, should only occur years down the road when your portfolio hits a critical mass. We are talking about crossing that 6-figure milestone. Only then do you shift from aggressively accumulating capital to defensively harvesting yield. In the end, as you stare at your trading app today, you have to ask yourself one final question. Are you deploying capital just to afford a free cup of coffee next year? Or are you building a compounding machine designed to buy back your time? When that first $100 goes